What if I told you that America may already be in a recession, but most people simply don't realize it yet? Turn on the news and you'll hear experts talking about economic growth, strong corporate earnings, and resilient markets. Scroll through financial headlines, and you'll see stories about stock indexes reaching impressive levels. Politicians from both sides continue to point to positive economic data as proof that things are under control. But then step outside and talk to ordinary Americans. Ask them how they're feeling financially. Ask them whether life feels easier today than it did a few years ago. Ask them whether they're saving more money, buying homes, or feeling optimistic about the future. The answers tell a very different story. Millions of people are working harder than ever, yet somehow falling further behind. They are earning more dollars but buying less with those dollars. They are carrying more debt, paying higher bills, and watching opportunities that once seemed normal drift further out of reach. That is why today I want to discuss something that few people are talking about openly: America's hidden recession. And once you understand what's really happening beneath the surface of the economy, you'll never look at the headlines the same way again. Before we begin, if you enjoy deep discussions about economics, investing, wealth building, and understanding the forces shaping our future, make sure to like this video and subscribe to the channel. It helps support our work and ensures you never miss future insights that go beyond the mainstream narrative. When most people hear the word recession, they imagine a dramatic economic collapse. They picture mass layoffs, plunging stock markets, bankrupt businesses, and panic everywhere. But history shows that economic weakness doesn't always arrive in such an obvious way. Sometimes it develops quietly. Sometimes it hides behind strong-looking statistics. Sometimes it affects ordinary families long before economists officially recognize what's happening. That's exactly what makes a hidden recession so dangerous. By the time it becomes visible to everyone, much of the damage has already been done. Today, many Americans feel financial pressure every single day, even though traditional economic indicators haven't fully reflected that reality. The gap between official numbers and everyday experience has rarely been larger. One of the biggest reasons people misunderstand the economy is because they confuse Wall Street with Main Street. The stock market is not the economy. Corporate profits are not household finances. A rising stock market can make investors wealthier while millions of working families struggle to pay their bills. In fact, some of the strongest stock market performances in history have occurred during periods when large portions of the population experienced significant financial stress. When people see markets rising, they assume prosperity is widespread, but prosperity is not measured by stock prices alone. It is measured by whether people can afford housing, healthcare, education, food, transportation, and a reasonable standard of living. And for many Americans, those essentials have become dramatically more expensive. Housing provides one of the clearest examples. For decades, homeownership represented a cornerstone of the American dream. Families worked hard, saved money, bought homes, and gradually built wealth over time. But today, that pathway has become increasingly difficult. Home prices remain historically elevated in many areas, while mortgage rates have made monthly payments far more expensive than they were just a few years ago. Young families who once expected to purchase their first home are finding themselves priced out of the market entirely. Others are delaying major life decisions because housing costs consume such a large portion of their income. The consequences extend beyond real estate. When people cannot afford homes, they delay furniture purchases, renovations, appliance upgrades, and countless other economic activities that traditionally drive growth. At the same time, rent has become a growing burden. In many cities, renters are spending an unprecedented share of their income simply keeping a roof over their heads. The result is less money available for savings, investments, retirement contributions, and discretionary spending. This financial pressure may not appear immediately in government reports, but families experience it every month when bills arrive. The hidden recession often begins not with job losses, but with declining financial flexibility. People become trapped in a cycle where nearly every dollar earned is already committed before it reaches their bank account. Another warning sign is the explosive growth of consumer debt. Debt itself is not always bad. Used responsibly, borrowing can help individuals buy homes, start businesses, and invest in their future. But when debt becomes necessary just to maintain basic living standards, it signals something much deeper. Across America, millions of households are increasingly relying on credit cards to cover routine expenses. They're using borrowed money for groceries, gasoline, utility bills, and healthcare costs. This creates the illusion that consumer spending remains strong, but spending supported by debt is fundamentally different from spending supported by income growth. One represents confidence, the other often represents survival. History teaches us that credit cycles play a central role in economic expansions and contractions. Easy credit stimulates growth because it allows consumers and businesses to spend more than they otherwise could, but excessive debt eventually creates fragility. As interest costs rise, borrowers have less money available for future spending. Defaults begin to increase. Economic activity slows. What appears sustainable during good times can suddenly become a major problem when conditions change. That is why debt deserves so much attention. It often serves as an early warning signal for larger economic challenges ahead. The labor market presents another layer of complexity. On the surface, employment numbers may appear healthy, but employment statistics do not always capture the full picture. A person working two jobs to make ends meet counts as employed. Someone forced to accept lower-paying work after losing a higher-paying position still counts as employed. Workers who stop searching for jobs altogether may disappear from certain measurements. As a result, headline employment data can sometimes mask growing financial stress beneath the surface. Many Americans report feeling less secure about their future despite maintaining employment. They worry about automation, artificial intelligence, outsourcing, and economic uncertainty. Confidence matters because confidence influences spending decisions. When consumers feel uncertain, they become more cautious. That caution eventually spreads throughout the economy. Small businesses often experience these shifts before anyone else. Large corporations have access to capital markets, extensive resources, and global revenue streams. Small businesses do not enjoy the same advantages. They rely heavily on local customers and local economic conditions. Across the country, many business owners report rising costs, shrinking margins, and increasingly cautious consumers. They face higher borrowing expenses, higher wages, higher insurance premiums, and higher operating costs. At the same time, customers are becoming more selective about where and how they spend money. These pressures squeeze profitability and limit growth. Because small businesses employ millions of Americans, their health plays a critical role in the broader economy. One of the most overlooked aspects of today's economy is the impact of inflation on psychology. Even when inflation rates begin to slow, prices often remain elevated. Consumers don't compare prices only to last month. They compare them to what they remember paying a few years ago. When grocery bills, utility costs, insurance premiums, and housing expenses rise significantly, people feel poorer even if their income increases. This phenomenon creates a disconnect between official economic reports and personal experience. Statistics may indicate improvement, yet households continue to feel financially strained. The emotional impact of inflation can linger long after the initial price increases occur. Meanwhile, wealth inequality continues to widen. Asset owners have generally benefited from rising stock prices, real estate appreciation, and investment gains. Those without significant assets have experienced far fewer benefits. This divergence creates two very different economic realities within the same country. One group sees expanding wealth and opportunity. The other sees rising costs and diminishing financial security. When economic gains become concentrated among a smaller portion of the population, overall growth may appear healthy while underlying social and financial pressures continue to build. Technology is adding another dimension to this challenge. Artificial intelligence has the potential to transform industries at an unprecedented pace, while technological innovation has historically created new opportunities. Periods of transition can be disruptive. Workers increasingly wonder whether their skills will remain valuable. Companies are exploring automation to reduce costs and improve efficiency. Investors celebrate productivity gains, but employees often worry about job security. These concerns influence behavior long before actual layoffs occur. Fear of future uncertainty can reduce spending and increase saving, both of which can slow economic activity. When we examine economic history, one lesson becomes clear. Major turning points rarely feel obvious when they first begin. Most people recognize recessions only after they are well underway. Most people identify bubbles only after they burst. Most people notice structural economic shifts only after those shifts have already changed their lives. The hidden recession operates according to the same principle. It develops gradually. It hides behind optimistic headlines. It affects households unevenly, but over time, the evidence becomes increasingly difficult to ignore. That doesn't mean disaster is inevitable. Economic cycles are natural. They have occurred throughout history and will continue to occur in the future. Every period of uncertainty also creates opportunities. The key is preparation. Individuals who build financial resilience are better positioned to navigate difficult environments. That means controlling unnecessary debt, maintaining emergency savings, investing in valuable skills, diversifying sources of income when possible, and focusing on long-term decision-making rather than short-term emotions. Financial strength is not built during crises. It is built before crises arrive. The most important takeaway is that economic health cannot be judged solely by headlines, political speeches, or market performance. Real economic health is reflected in the daily experiences of ordinary people. Can families afford homes? Can workers build savings? Can young adults envision a better future than their parents had? Can businesses grow sustainably without relying on excessive debt? These questions reveal far more about the economy than any single statistic ever could. America's hidden recession may not look like the recessions of the past. It may not arrive with dramatic market crash or immediate panic. Instead, it may continue to unfold quietly through affordability challenges, rising debt burdens, shrinking purchasing power, and growing financial insecurity. The danger lies not in recognizing these trends. The danger lies in ignoring them, because throughout history, those who understand economic cycles early are often the ones who adapt successfully, while others are caught by surprise. The real question is not whether warning signs exist. The real question is whether people are paying attention before the rest of the world finally notices what has been happening all along.